Welcome to the first episode of Tax 411. My name is Edwin LoCarpio, and I'm a licensed CPA in the state of California and Washington State. And in today's video, I want to address reasonable compensation for S corporations. The reason being is that I've recently come across various sources of information detailing different methodologies and different recommendations to calculate reasonable compensation. And in my opinion, if these recommendations are followed, you may trigger an IRS audit. Now, just as a disclaimer, while I'm a CPA, I'm not your CPA. So I encourage you to reach out to your tax professional in your area to see whether reasonable compensation directly applies to your situation. With that said, let's get started. There's been a lot of information in the news recently about the IRS, but one takeaway is vitally important: that the IRS in the near future intends to audit S corporations at a much higher rate, specifically focusing on reasonable compensation. So first and foremost, a more than 2% shareholder of an S corporation is required to pay themselves reasonable compensation. But what is reasonable compensation? Well, reasonable compensation, as defined under Code Section 1.1627B3, is the value of services that would ordinarily be placed for like services by like enterprises under like circumstances, meaning that reasonable compensation is not tied to net income. It's not tied to the profits of the S corporation, but instead, reasonable compensation of a shareholder-employee is tied to the value of services he is providing the S corporation. So before we delve into the IRS approved approaches in determining reasonable compensation, I think it's important to first address the incorrect recommendations I recently discovered that, in my opinion, have often led to misconceptions in calculating reasonable comp. So the first source that I discovered recommended a splitting of net income, whereby the shareholder employee would be taking either a 50-50 split or a 60-40 split between salary and distributions. But the issue here is that there is no correlation with the value of services that the shareholder employee is actually providing. Another source indicated that there was this IRS audit technique guide that specified that if the shareholder employee took 30% of their net income as their reasonable compensation, that the IRS would deem that as reasonable. Once again, taking an arbitrary percentage of your S corporation's net income does not correlate to the value of services you're actually providing. Now, one note here is that I had attempted to find this IRS audit technique guide. There is no such thing. There is, however, a IRS revenue manual that does specify 12 factors that an IRS agent needs to consider in auditing reasonable compensation. In addition to that, there is a IRS Fact Sheet version 2008-25 that provides the taxpayer 9 factors in evaluating what the reasonable compensation should actually look like. Now, both the Internal Revenue Manual and this IRS Fact Sheet do share common factors that correlate to the value of services. Such factors are knowledge, expertise, the time devoted to the business, and the employee's responsibilities. Now, I have provided links to both the IRS Internal Revenue Manual and the IRS Fact Sheet in the description below for you to review. So the IRS has approved 3 approaches in determining reasonable compensation. The first is the cost approach, which is better known as the many hats approach. The second is a market-based approach, and the third is a income-based approach. Now, don't attribute the income approach to either a splitting of net income or taking an arbitrary percentage of your net income. Instead, think about it as a hypothetical shareholder-employee who is considering a level of compensation that is justified to the financial performance of the business. Now, the reason why the IRS has approved the cost approach, the market approach, and the income approach is because they all tie to the value of the services that the shareholder employee is actually providing. Now, why is it important for you to obtain a reasonable compensation analysis? Well, think about the comp analysis as an insurance policy. So let's take, for example, a shareholder employee who decides to use the splitting of income method in determining their compensation. And let's say in the following year, they get a letter from the IRS indicating that they want to audit their reasonable compensation. Well, the first question that the revenue officer is going to ask is, how did the shareholder employee determine their reasonable compensation? And just as soon as they say, well, we split our income, that's going to put a smile on the revenue officer's face, because now they can look to distributions and they can potentially reclassify a portion of the distributions, or in some cases, all of the distributions, as taxable wages. In addition to that, due to those additional taxable wages, the shareholder employee is also going to incur more payroll tax and incur penalties and interest. Now let's take that same example, but instead, let's assume that the shareholder employee obtained a reasonable compensation analysis. So the first question that the RO is going to ask once again is, what methodology did you use to determine your reasonable compensation? And all the shareholder employee has to do is just give the revenue officer the reasonable comp analysis. The reasonable comp analysis is going to cover all of the 12 factors that the revenue officer must consider in auditing reasonable compensation. And because the reasonable compensation covers all of the 12 factors, the revenue officer can't do anything, i.e., they cannot take a look at the shareholder employee's distributions and potentially reclassify them as taxable wages. So I would encourage you to reach out to your tax professional to see whether they are able to perform a reasonable compensation analysis for you. And if they unfortunately cannot, I would seek a CPA who can actually perform that service for you. So the next time you are thinking about what your reasonable compensation is going to look like, I want you to keep in mind 4 things. First is that if you are a more than 2% shareholder of a subchapter S corporation, you are required to pay yourself reasonable compensation. Number 2 is, remember that your reasonable compensation is tied to the value of services you are providing your business. Number 3 is that I encourage you to review the 12 factors that are in the Internal Revenue Manual, or the 9 factors that are on the IRS Fact Sheet 2008-25. Last but not least, I encourage you to reach out to your tax professional to see whether they can provide a reasonable comp analysis for you using one of the 3 approaches. And if they are unable to provide you a reasonable comp analysis, find a CPA who can. Thanks for watching another episode of Tax 411. If you enjoyed this episode, please hit the like button, and please don't forget to subscribe to the channel, share with your friends, and follow us on all social media platforms.